Well, the market has been choppy and now the indices have moved into the green. The advance to decline ratio turns favorable as well. Energy and metals are the big gainers while financials drag.
REC expects to double its assets under management to $125 billion by 2030 and sees limited impact of RBI's proposal on its Tier 1 capital as projects backed by the government fall outside the purview. The stock gains.
Dr. Reddy slips on a weak show in the US and Russia. Pidilite sulks on a miss in profits, while Voltas slides on missing margin expectations by a wide margin and reporting a dip in market share.
India's chief economic advisor says India should aim for longer growth cycles rather than higher growth. He adds that India should focus on growing steadily at close to 7% annually. Hello and welcome to Halftime Report on CNBC-TV18. I'm Ekta Batra and with me is Mangalam Malu. Well, today seems to be a day of a breather, at least for the frontline indices. So we have the Nifty as well as the Sensex, which is just about consolidating as we speak. What stands out, however, is that the mid-cap index is in the green. Remember, yesterday was a sharp fall. It was the worst day that the mid-caps have had in the past 2 months. And we have the advanced decline ratio, which is in positive terrain as well. So that's a definite positive. It's currently standing at around 1.4:1 on the Bombay Stock Exchange. Let's see how that moves as the day progresses. So this is what the status looks like. Bank Nifty underperforming, down around 0.4%. Let's see whether that recuperates. We have a lot of numbers to react to and a lot of numbers today as well. Big boys such as Hero Moto, L&T, all of these companies will be releasing numbers. So I think stock-specific action amidst, maybe volatility ahead of the election outcome continues.
It seems a lot better today than earlier, Ekta. If you just take a look at the way the markets recovered from the lows, the mid-cap index doing extremely well, telling you that we are near the bottom end of the range in which the Nifty was, between 22,300 to 22,700. And 22,300 also is the 50-day moving average. The mid-cap index usually moves before the frontline indices, and now the broader markets are telling you that maybe for now, there are signs of some exhaustion in the selling that we've seen. Not to mention that the FIs continue to sell in the cash market, but at some point, the quantum of shorts that are built in the system will, have to cover their positions, and that would lead to a bit of an uptick as well. And as we speak, a lot of individual stocks in focus. We're talking about Radico Khaitan at the bottom of your screen. We've been talking about how gin has been one of the fastest growing spirits market over the last couple of years, and Radico Khaitan has gone ahead and gained market share with its Jaisalmer Indian craft gin, leading the luxury craft gin space in India. An interesting anecdote about Radico Khaitan, they've caught the trend before everyone else. When vodka was the drink which was growing much faster than all the other spirits, they went ahead and launched Magic Moments. And when Indian whiskies were doing well, they launched about 8 p.m. So all these factors doing well for them. And also, very recently we got the news of them selling their Jodhpur craft whiskey at around 5 lakh rupees a pop, and that doing extremely well too.
And so, sold out, right?
Sold out. I mean, it was just 400 bottles, so it was made to sell out.
Absolutely.
But this one is good
5
news.
lakhs on one bottle, which is a consumable.
We'll most definitely get 400 people in the world to consume a bottle for 5 lakh rupees as well. But speaking about Daru, let's move on, talk about Dawa, because that's the one that is, making the news this afternoon. Dr. Reddy slumps in trade after its fourth quarter numbers. Street doesn't like the margin, the contraction sequentially. In our special Insight Edge segment, Ekta talks about what the management said to us and what you made of that, Ekta.
Well, yes, I'm going to focus on what were the key disappointments and the reason why the stock is lower by around 3.5%. Now, the key reason why that took place is because the margins disappointed, 26.4% versus 25.9% year-on-year, but versus expectations of as much as 28%. The company said that they incurred an R&D expense, which was higher this quarter. It was impacted by higher expenses this time round. And going forward, their guidance of around 25% EBITDA still sustains, and that will give them flexibility for future investments as well. So that's what the management said. Now, the other key disappointment was the US sales. $391 million versus estimates of $350 to around $412 million. Yes, there were lower end estimates, but more of the street was expecting $400 million plus for Dr. Reddy's this quarter. This $391 million is a sequential decline for them. They've done lower sales in the US than they did in the previous quarter. Now, the street is wondering it's possibly because Revlimid generic sold lower amounts. So there are some estimates that they sold $60 million as compared to over $100 million in the previous quarter, but the base business probably held up for them. Now, Dr. Reddy's has said that they remain consistent in the US like previous quarters. Base business saw more market share in key products. It's been a meaningful quarter for them when it came to Revlimid generic. They're expecting key drugs to continue being meaningful in FY25 in the US, and they're aiming to launch 20 plus products in the US and going forward as well. So they're quite bullish on the US. Let's see whether this $390 million mark also sustains for them. Now, overall guidance by the company is that they aim to grow the domestic business by around 10%. This is X of the Nestle JV deal. The rest of the world market should probably grow in double digits for them. They've also received a voluntary action indicated status for their Bachupalli formulation facility. Now, brokerages a bit sanguine. CLSA underperformed, target price 6,080 rupees. They believe there's a subdued midterm outlook. Jefferies has an underperform with a target price of around 5,010 rupees. And Nomura is neutral with a target price of 6,499. In fact, we did speak to Mr. Erez Israeli. Let's listen in to what he had to say.
This is just a timing of orders and supply. The US stay consistent like in the quarters before, or with all the levers, meaning the base business with more market share, new products, and lenalidomide. So we see that as a consistent quarter also in the US. In general, this quarter we had more expenses on R&D. Some of it is what you call seasonality. We have quite a few submissions in the end of the quarter. In addition to that, we are involved in several business development, and we have certain expenses behind them, plus a licensing fee of some products. So overall, this was impacted our expenses primarily. We believe that the 25% EBITDA give us a great sweet spot between how much we want to invest for the future.
All right, before we slip into a short break, just pull up the intraday chart of United Breweries. Now that stock has recovered a good 2.5% from the lows this morning. Remember, the street wasn't very happy with the margins that the company reported this time around, but then we spoke to the management. They said that margins will see sequential improvement. They've guided for double-digit volume growth in all of FY24, with market share increasing as well. They've gained about 130 basis points in the last quarter. At the same time, they will get increased share coming in from premium products as well, from 20 to 25%. So maybe some bit of recovery is what we're seeing out there. We'll monitor how this goes about. But take a short break. On the other side, we get you an exclusive conversation with Siemens India MD and CEO Sunil Mathur. Stay tuned.
Welcome back. Well, let's focus on one particular company now, Siemens. It tells CNBC-TV18 that their India order book has shown a terrific growth in the last 5 years, and India is their fastest growing market globally. On the sidelines of Hannover Messe 2024 in Germany, Yash Jain caught up with Sunil Mathur, who's the MD and CEO of Siemens India, to discuss their business outlook, and began by asking him where is the India market positioned for Siemens globally. Listen in.
Well, India is the fastest growing market for Siemens globally. So that's a very clear statement. There is a lot of focus of the global board and our CEO on India very clearly for various reasons. One is the last 5 years have been a proof point of what India can actually do. The growth of India, the investment in infrastructure has actually kicked off a lot of ancillary production coming in. And that has become hugely interesting to the global organization here. So I do see the next 5 years as being a step up in private capex, which is what interests us straight away, right? We've had a first start of infrastructure, which is the foundation.
Correct.
That will continue. But then on that now, slowly private capex will start kicking in.
Okay.
And it has started kicking in. It takes time, but it will start kicking in. And when that comes in, we will need to adopt it much faster. The only way to adopt it is digitalization and technology. And that's where Siemens is right at the heart of it.
Correct. You cued me to my next question as well. Right now, it's largely the government in India which is doing the capex, which is also getting you a great amount of orders. Once the private capex also starts kicking in that context, what I want to understand is FY25 right now, FY24 as we end, where does your order book stand that you have at Siemens India over the next 2 to 3 years, or maybe 5 years, consecutively year after year? What is your estimation in terms of growth of order book in terms of numbers?
So I won't guide over there, but I think our track record in the last 5 years has shown a terrific growth. We want to exceed that growth in the next 5 years. We don't see any reason why it cannot be much faster than what it has been in the last 5 years. We've had large orders coming in. We got the €3 billion, 30,000 crore order for locomotives. The railways is now picking up on rolling stock. Vande Bharats are coming in. Train signaling systems are coming in, etc. There's a huge potential on the rolling stock side over there. There's a huge potential on industrialization as private capex kicks in over there. There's a huge potential on smart infrastructure and the energy transition as well. As the country moves much more towards renewables, the entire network will have to be upgraded to take care of the frequency matches over there. The entire discoms will need to be looked at as well. So that is the extent of the opportunity that India has. And I believe the next 5 years all of this will kick in.
Okay. In that case, I mean, is it possible to see the order book also doubling over the next 5 years as you see the kind of growth which is sort of coming? Is that sort of
I don't see a reason why not.
Okay.
I don't see a reason why not. A lot of it depends on the mix of orders, of course.
Correct.
You know, you get one large project order and then you jump up. The next year you may not get a large project, but you grow on the base business. But I would like to definitely believe that both our base business as well as the mega orders will definitely increase.
Just like we saw in FY24, FY25 as well, any large order to the size of what we saw in the previous year expected?
We are bidding. We are bidding for a lot of projects, both on the railway side, on
Any
metros.
number, how much are you bidding for? I mean, as far as...
No, I don't have it offhand.
Okay.
But I think it is important to say, the moment you start, a large order could be a large railway order on the one hand, but then you have got large orders which are much smaller in size for digitalization, software business, or smart infrastructure. All our factories are full, which is a great indication. We're full for the next couple of years. We're expanding capacities. So that's a very, very good indication.
Of course, you're growing the order book, but what has been the margin trend out of the order book that you derive year after year?
I think our endeavor is very clear. We don't only want to grow the top line, we want to grow the bottom line as well. And we've changed the mix. We had a large number of project orders. We're now balancing those with a lot of short supply orders as well, where the margins are better. There's a lot of vagaries of supply chains involved over there that we are having to deal with, but the endeavor definitely is to grow the margin.
How big of an opportunity could railway be? Where does it stand out of your mix today? And how could that change in favor of railways, let's say, in the next 2 to 3 years?
So mobility, railway business for us is very, very large, and it's a growth market without a doubt. For many years, there was not too much happening. And in the last 3 years, I think we have seen a substantial pickup in the tendering activities over there. And it starts with the signaling side, electrification. We are almost 97, 98% electrified as a country. So that's going to continue as the network expands. But signaling is a huge opportunity over there. We have to upgrade the signaling network. The government is already working on that. But of course, getting the tracks up done, getting the rolling stock up to speed, increasing the weight-bearing capacity of cargo trains, as well as the speed of the cargo trains, is a major area of focus for the railways. And I think those are all like areas of business that we are very much interested in.
India is, of course, a market which is looking very aggressively at electric vehicle industry. For you, of course, you have certain partnerships, but that is still on the commercial vehicle side. A large section of that market is also passenger vehicle. What is your view? Would you look at aggressively making partnerships on the passenger vehicle side also?
We've started out on the commercial vehicle side because we believe that's a market that is there and that is real and that is growing. We acquired a company. We are using the technology of that company, scaling it up, and that's already gaining great traction. We will look at the passenger area. We are looking at partnerships. We are looking at acquisitions in all areas, not only in e-vehicles, but in all the areas that we do business in. So M&A will play a central role to our strategy.
There was an important and a large exit also which was made, and which sort of the company shifted into the parent. Could we see more streamlining of businesses, if I could call it that way, where certain exits would be made, maybe to the parent company or to somewhere else, where business is more efficient and you come out of businesses which are not required in the coming year?
Well, I think if you look at the history, we have taken out a lot of businesses. We've acquired a couple of businesses as well. But this has all been in line with the global strategy, right? When they have taken out something globally, we've done it locally. And we have done it also because it makes sense over here. If the focus has to shift to move up the value chain, then a lot of the businesses that do not follow that strategy need to fall by the side.
Absolutely.
And that's a continuous process that the parent company follows and that we will follow as well over here on a continuous basis.
Announcements
it's a very
in the next year?
fast-changing
Any announcements
world.
in the next year in terms of exit?
Well, we will see. We will examine the environment overall.
Okay.
And look at what makes sense. But I can't say nothing will happen.
Okay.
At the same time, I can't confirm that will happen.
Welcome back. The market's now recovered a fair bit. The Nifty is at the high point of trade. From the lows, it's seen a big recovery. The Sensex 2 up 100 points. And as we speak, it's the mid-cap index which is leading this recovery with a gain of almost 0.5%. The Nifty Bank, which at one point was down by about 1%, now is curtailed its losses to just about 1/3%. And that's where, the thesis of where the market is likely to go in the second half stands out, because we're seeing Reliance, L&T and SBI, all three as the top contributors for the Nifty, and some amelioration for the Nifty Bank as well. Reliance, obviously by virtue of its weight, SBI reports its numbers tomorrow, L&T reports its numbers today. For the Nifty, it seems like now it's moving around in this band of the 50-day moving average, 22,300 at the lower end, to on the way up, it's the 20-day moving average, 22,445, that we'll keep an eye out on. At the same time, the Nifty Bank is around that 48,000 mark, right in the middle of both the 50 and the 20-day moving averages. And as things stand on the Nifty, put writers are back again at that 22,200 put, which is closer to today's low, telling you that 22,250 to 22,300 would be an important support. On the way up, however, 22,700 could see some bit of congestion, but we're still seeing 22,400 call writers active, telling you that maybe a speed bump at around 22,500. Nifty Bank, it's the weekly options expiry today. Where are we? 48,000 on the Nifty Bank, 48,000 put is which is most active with the highest open interest. But on the way up, it's the 48,200 call as well, which is equally active with a high amount of open interest. So are we looking at some bit of a range between 48,000 and 48,300? Maybe that is something for Shilpa Raut, who's joining in to answer. Shilpa, where is your market positioning right now? What would you suggest for the second half?
Good afternoon, Manglam, and thank you for having me on the show. Talking about, yes, the position, this was, expected a pullback rally after 2-3 days of, this fall that we witnessed. This is a pullback rally that was on unexpected lines as behaving. So, but this 22,350 to 22,400 my tax is a resistance now. So the intraday range is well defined for a few days, I believe, would be in between 22,200 to 22,400. 23,400 to 450. So playing the range is wise. We have to decisively breach below 22,200 to see levels of 22,000 to 21,800, or above a close above 22,500. We'll see some more traction where 22,800 can happen. Talking about Bank Nifty is holding as of now 48,000 zones, but there's not much of a strength that we see in Bank Nifty, where we can say that an intraday rally towards 48,500 to around 48,800 can happen. So this Bank Nifty would be an avoid index for me now.
Oh, okay. Shilpa, hi. Welcome to the show. What would your stock picks be today?
Hello, Ekta. The stock picks would be, I have one buy and one sell. The buy would be Navin Fluorine. Navin Fluorine, the results are done and dusted, but yet the stock is holding on to the positive territory. And, knowing the stock behavior pattern, I believe from here it should move towards 3,600. It has a good support at around 3,380 zones. From here, I believe, a few sessions. 3,600 can be seen. So I would be a buyer in Navin Fluorine right now in futures with a stop loss of 3,380. The stock in futures is trading at around 3,428 right now. The other one would be a sell in AB Capital. Again, futures levels, it is trading below 220, which is little negative for the stock. It can do 210 to 200 again with a stop loss of 222 in futures. You can definitely go for a sell in AB Capital.
Right, Shilpa, thank you so much for joining in and giving us your views on individual stocks and the index. Take a short break, come back. On the other side, we have management of Pidilite joining in for their fourth quarter numbers.
Welcome back. Well, let's focus on another company now. Pidilite is in focus in trade today. It is down despite reporting a good performance in Q4, although there was a miss on the EBITDA and profit. The company's internals suggest improvement in business. Manglam, my co-anchor, did catch up with Bharat Puri, the MD of Pidilite Industries, to discuss in detail about the company's Q4 performance, and began by asking him about the rural demand outlook. Listen in.
As far as rural demand is concerned, frankly, we have been the one company that has consistently actually not had a problem with rural demand. Whether it was, starting from the beginning of the year, we have consistently delivered over double-digit volume growth in rural, and that continues so. So I'm not sure, now do we expect a greater upsurge from there? Frankly, let the monsoon happen, let the stability return from a government, etc. point of view, so on, and we'll see. But if you look at the tailwinds that we have as a company, whether it is the upsurge in real estate and the upsurge in construction, whether it's the increased government spending on infrastructure, whether it is the consumer attitude towards homes and the investment in homes, frankly, we're in a good position. And if you look at our, consolidated result for the full year, not just one quarter, we have consistently guided and said our objective is double-digit volume growth at a margin of 20 to 24%. Well, we have delivered double-digit volume growth and underlying volume growth. Mind you, where tonnage volume growths are obviously much higher, but then that doesn't take into account mix. And we think underlying volume growth is a far better indicator of performance than is total volume growth. Having said that, and we also said that we will be in a 20 to 24% range on EBITDA margins. We're at 23%. So at overall, frankly, we're quite satisfied with the year. We're quite optimistic over the prospects. We may have some minor disruptions in the next 1 or 2 months. This is a very long election. Elections always cause some amount of disruption because of movement of people, logistics, so on and so forth. But frankly, all of that is temporary. If you ask me, are you confident on the prospects of the year? Absolutely, yes.
All right. So, let's talk about the margin bit a little bit more, because while your gross margins are at the higher end of the range or the highest that they've been in the last many quarters, your EBITDA margins are still at the lower end of the range, at closer to 20% for the fourth quarter. So what one needs to understand is that this increase in expenses that have taken place recently, is this structural in nature, or is it just strategic because you have to boost the demand?
See, we've always repeatedly said that we do not manage margin by quarter. if you look at my third quarter margin, it is 25%. At that point of time, everybody wanted to know whether this will continue. And we said, no, please stick to our guidance. On an annual basis, we will be at 20 to 24%. In the fourth quarter, we've obviously invested behind our brands. We've invested behind a set of route to market initiatives. So it's not a structural piece, but overall, we're clear that, listen, we manage our margin in a band and our products command a certain price premium. We don't let it go above that. We would rather reinvest for greater volume growth. And therefore, if you ask us, our mantra remains unchanged. Our mantra is profitable volume growth.
All right. So you've been pretty clear on the EBITDA margin front. What about gross margins? I mean, are they at the higher end of the range? Should we see a little more increase from here? Or maybe they've stabilized after the kind of decline that we've seen in input prices?
I think we're now largely stable. We're seeing input prices have bottomed out clearly. In fact, we're seeing the first signs of inflation, but very minor, and that's normal. Some raw material price will go up, some raw material price will go down. I think, barring any black swan events these days, the greater fear is geopolitics rather than anything else. But at least for the first 6 months, it appears that raw material prices will remain stable, will remain moderated as they are. Post that, frankly, both you and me don't know. We'll discuss next quarter.
All right, we'll discuss that next quarter. What about waterproofing? I mean, you've been the pioneer here and you've also had a lot of mind share. Do you still have the same market share? Because I spoke to Asian Paints a couple of months ago and they said that they are bigger than even you in the waterproofing space. So is your edge still intact?
See, as far as we're concerned, we look at our growths. We look at, everybody these days tends to define waterproofing in different fashions, so on and so forth. The paint companies tend to add their exterior paints to waterproofing, so on. Frankly, as far as we're concerned, there is a massive runway for growth as far as waterproofing is concerned. Even today, it's 4 out of 10 homes in India that are doing any form of waterproofing. Are we growing strong double-digit growth in waterproofing? The answer is yes. Is our brand the most salient brand? The answer is yes. Do others have good growths? Frankly, that's their lookout. As far as we're concerned, as long as we're satisfying our consumers and satisfying hopefully more of them on a consistent basis, we're not worried at all.
All right, so your core is going good, your innovations are going well. What proportion of your sales currently comes in from products and categories that have been launched in the last 3 years or so, and what rate is that likely to grow?
See, we're clear that for Pidilite, innovation is a very strong driver of growth. We're a company that's known for our innovation in product, innovation in communication, advertising, so on. So across all of our divisions, we've got a whole range of new products. There's a new variant of Fevicol by the Fevicol division. There are a whole set of new products in waterproofing. The art materials division has a new set of products. If you look at Fevikwik, we've expanded the full Fevikwik range now. We've got Fevikwik variants starting from 5 rupees to 75 rupees. So as far as innovation is concerned, we're always clear that 1/3 of our growth must come out of innovation. We're a company, products launched in the last 3 years, and we're now very close to that number.
All right. Any other parameters for you other than, just increased offtake to gauge sentiment on the market? Is there any movement there?
See, what we are finding is clearly there is a tailwind as far as real estate is concerned. And when the real estate cycle turns, the good thing is it tends to turn for, between a 5 and 10 year period. And as a home improvement company, we will see the real benefits in what I say T+2 and T+3. Starting from construction, year 2 and year 3 is when our products come into full use. And we are seeing that now beginning to play out. Clearly, the government's push on infrastructure also helps our sector fully. And the consumer attitudes towards the home. What we are doing clearly is 4 things. A, obviously, making sure our supply chain is geared for the future. You would see this year, again, we've opened 10 new plants this year. We still have some other new ones under consideration, which we will talk about next year. As far as distribution is concerned, we've added 40,000 new villages to our direct coverage. I now have 13,000. When we talk of rural, we've never said rural is the problem because we've consistently invested ahead of the curve in rural. We now have 13,000 Pidilite Ki Duniyas, our small retail stores in villages between 5 and 10,000. So we're consistently investing behind growth. As we find the margin elbow room, our objective is go back to double-digit growth. Fortunately, we're now back there. If we look at our volume growth, Mangalam, over a 4-year period, we have a double-digit CAGR over 4 years. Frankly, that's what in a sense, we've added pretty much one customer to every two customers that we already had. And I think that's our greatest indicator of success.
All right, and final question then. The big change that has happened between last time and now when we spoke, you appointed Sudhanshu Vats as the designate MD, and you've also onboarded Kavinder Singh as the joint MD designate. Why the need for two, and what's the mandate given to them?
See, very clearly, as far as Pidilite is concerned, you've seen we've been fortunate to grow at a very healthy pace. We're also a company that is across a large number of sectors. We now have 37 to 39 verticals. And we felt that the management of the organization, therefore now needs a newer structure. So we have a managing director, we have a joint managing director, we obviously have the board. So this is, again, you will see Pidilite has been one of the few companies we've prepared for succession much before. Sudhanshu was on board 2 years earlier. We've already, outlined a succession plan, which will actually, in a sense, play out from April next year. This is really just being future ready and hopefully future proof.
Future ready and future proof. That's the word coming in from Pidilite's Bharat Puri. I mean, the stock can do what it has, but in the past, it's been a big wealth creator, and the management hasn't wavered away from their long-term guidance as well, which is double-digit volume growth with margins between 20 to 24%. The only difference this time around could be some sort of disruption in the very near future with people movement during the elections. So let's see how the second half, the latter part of this year does play out with a lot of the tailwinds that Mr. Puri did speak about. We take a short break. As we do that, here's an announcement that we'd like to share with all of you. Our upcoming live personal finance webinar, CNBC-TV18 Accelerate, will feature none other than top market expert Nilesh Shah, the MD of Kotak Mahindra AMC, who'll answer all your questions on managing money. Also conduct a special masterclass on what not to do or the mistakes to avoid when it comes to financials. CNBC-TV18 Accelerate Personal Finance Handbook with Sonia Shenoy will also feature 3 well-known experts to deep dive into everything you need to know to master your finances and learn how to grow your wealth. Don't miss this chance. Join us on the 11th of May, 9 a.m. Welcome back. Now we've lined up for you a very interesting discussion on a report that has come by from Knight Frank, where they've said that retail sector in tier 2 cities has been relatively under-penetrated as compared to tier 1 cities. But the opportunities is, what we are looking at in the entire retail space, more so now in tier 2 cities as well. Expected to grow at an 18% CAGR for the entire market between FY28 and FY29. To discuss this more about the retail space in India, we have Gulam Zia, who's the Senior Executive Director of Knight Frank India, joining in. Thanks a lot, Gulam, for joining in. The total shopping center stock of almost 125 million square feet across 340 operational assets, of which 77% belongs to tier 1 cities. So do you believe or belong to the camp that the next leg of growth comes in from tier 2? Or do you believe that where there is, concentration and consolidation, there is higher penetration and room for more growth there?
To start with, I would say, focus on tier 1 shall continue, because if we are looking at a few of these malls which are falling by the wayside in tier 1 cities, it's for various reasons, but your profitabilities are much higher in tier 1 cities. But that said, tier 2 cities, as you rightly pointed out, which with barely 1/4 of the overall stock in 30 top cities, is in tier 2 cities, and that's definitely a concern, where in most of these cities you would not have more than 2 malls, out of which one would be performing. So when I'm talking about some 21 to 22 tier 2 cities, amongst them, on an average, you don't have more than 2, 2.5 or 3 malls maximum, and that definitely talks about a lot of possibilities, and especially with wealth penetration, wealth percolation going into the semi-urban areas, I'm sure the propensity to spend is also going to be shooting up in tier 2 cities. So definitely the tier 2 cities is going to be a long journey ahead, and very good story for the retailers to look at.
Okay. Gulam, hi, welcome to the show. Well, that's exactly what I wanted to talk about, is this surge in ghost shopping centers. And correct me if I'm wrong, but those are those shopping centers where the occupancy or, the vacancy rate exceeds 40% and the occupancies are low. So can you give us a sense? There's been a 59% surge in these ghost shopping centers which have taken place. That means that there's a lot of real estate which is possibly freed up. Is that seeing traction? what kind of redevelopment are we going to see in these areas?
See, first of all, as you rightly identified, ghost malls are to be seen from the right perspective. Wherever occupancies are dipping, vacancies are shooting up. As we talk about 40% plus kind of vacancies are coming into that category of ghost malls. And the problem is, if the vacancy exceeds more than 25%, the mall is not going to make money. So when it is crossing 40, that means it's as good as dead. And that's the whole problem. When we are looking at how the growth of these centers is happening, we've categorized them into three different buckets: grade A, grade B, and grade C. About 132 malls fall in that category, which is C grade categories. And in that category, the average occupancy, average vacancy is crossing 38%, which was 32% last year, which means they are going down the slope and definitely require some different way of rejuvenating them or bringing them back in some other avatar, which is what is also happening. In many of the places, the malls are giving way to office buildings, because office as an asset class is outperforming for last at least a year and a half or two. And going forward, we do see a good progress for the office stock to office occupation to continue. So that's obviously one of the easiest thing to do is to convert them into something like an office, because residential is not possible. The kind of floor plates, etc., you cannot convert them as it is into residential unless you demolish them and reconstruct, which is also happening. In a few cases, we have been watching demolitions happening to give way to some other asset class. But as you rightly said, if I look at land and building valuations together, we are staring at about $2.5 billion US amongst those 56 or 57 assets that we are talking about, which are already dead or ghost malls. And we are looking at that number growing in times to come.
Right.
Okay.
I just wanted your thoughts on the rate at which supply will grow, because when we speak to companies, they speak about, wanting to grow their revenue share, wanting to expand their stores, wanting to, increase the stores that they reach, etc. as well. There seem to be a plateauing out in the supply that is coming, and also from the supply that is coming, you're saying that a lot of them are turning into ghost malls. So is that a problem? That can that be a speed breaker for the retail growth?
I won't say so. The problem, if at all we are focusing on the non-performing malls, we must also look at the performing ones. About 47 to 48% of overall malls that we're talking about are in A grade category, where the vacancies are below 5%. As a valuer, if I'm looking at these stocks, 5% is a saturated vacancy. Here in these malls, it is below that, which means retailers are queuing outside these malls to find some space to put their merchandise or show their stuff to the retailers, and that is not happening. And that number is also growing. So whenever the new malls are coming up, the new stock that we're talking about, most of this new stock is actually fulfilling the requirement of the new buyers. And what is that difference is what I would quickly take a minute to explain. On the other side of COVID, we realized that we could rely on e-commerce to do our consumption. But then what was differentiating e-commerce from the brick and mortar retailing was actually touch and feel, experience. And that experience, unless you give it to the customer, the malls are going to be on the downslide. And that's what is being observed. Even if a lot of those malls which are aged, which are old,
Sure.
need to rejuvenate and come back in a new avatar. And that will continue to happen in times to come.
All right, Ghulam, just before we let you go, just a quick brief comment from you. Is this the peak of these ghost malls or vacancies, or are we going to see an incremental rise in this year? And if so, how much? Just a brief comment.
Well, in last year, we have seen these numbers shooting up from 57 to 64. Number may not be that big, but the area that they occupied is really huge. Last year, it was barely about 8.5 odd million. It is now about 13.5 to 14 million square feet out of 125. And as I said, almost about 132 more malls are in that category where the times could turn them into an absolute ghost mall. And that number is going to be scary, which is what I said earlier. Unless we do something about those malls which are on the verge of collapse, this number next year when we'll be discussing and talking about it would be very, very scary.
Okay, all right. Maybe it'll be an opportunity for some real estate companies. You never know. But thanks, Ghulam, for joining in and talking to us and giving us that interesting perspective of the rise in the retail sector in some sections and the rise in ghost malls in the other. Well, we need to take a short break, but we'll get you more on the markets. A lot of stocks lined up. Stay tuned. Welcome back. Well, picked up a little bit of pace for the mid-cap index, so up around 0.6%. We have the Bank Nifty, which has shed its losses from the top as well, so just about lower by around 129 odd points. And the Nifty seems to be picking up a little bit of pace. Nothing really to write home about. We're still in consolidatory terrain, so up around 45 odd points for the Nifty. Let's see where we go from here. The good part is that the advanced decline ratio is improving as we move along. So around 1.5:1 is where we're at. We started the show at 1.4:1. But nonetheless, let's talk about numbers now. Hero Motors in focus ahead of its Q4 numbers. Sonia joins in with the key expectations from the auto major.
Well, thanks a lot for that. As you rightly pointed out, it's expected to be a very good set of numbers for Hero MotoCorp. The stock as well is up about 1% in anticipation of the numbers. Now, this has been a good quarter for them. So we are expecting a revenue growth in double digits, about 13%, 13.5% growth is what we're looking at. The margins will be stable for the company as well on account of better operating leverage. Now, we're expecting a core EBITDA growth of almost 26% for Hero MotoCorp. What has happened in this quarter is that the volume growth has been pretty steady. That's also because of the entry-level motorcycle segment demand coming back, especially in the rural markets. The volume growth was 9.5% at 13.9 lakh units. And because of the rural market recovery, we've seen a good growth. If you look at the chart as well on your screen, about 14 lakh units is what we've seen thereabouts for the last 3 quarters on a steady state, and that's something that the street likes. However, if you look at the stock, right, it is the cheapest stock in the automotive space currently. Compared to its peers, it's trading at a big discount, both compared to Bajaj Auto and TVS Motor. Hero trades at 18 times, which is the historic average as well. Bajaj is at 28 times, TVS is at 37 times. So there is perhaps some legroom for growth in terms of valuations. Also, the recent data which came out, which is the April sales numbers, it was the best of the pack, up almost 35%. So the ingredients are in place for Hero Motor to perform well this quarter. Back to you.
All right, thanks a lot for that, Sonia. So that's about Hero MotoCorp. We will wrap up on this edition of Halftime Report on that note, with the fact that with the news of the markets continuing to do market things, 22,350 on the Nifty. The Nifty Bank now just down by about 129 points. So very good recovery that we're seeing. It's led by the mid-caps and some of the large caps as well. Take your break and come back. We have Business Lunch waiting for you.